What we're seeing is an economy that's been quite resilient given the shocks it has experienced in the last year, year and a half, the Russian invasion of Ukraine, the energy crisis, and then the tightening of monetary policy around the world. Despite all of this, we're still seeing growth that is close to 3% for the global economy this year, and we're expecting about 2.9%, not very far from 3, next year. Now, what we're saying also is, 3% is, it's not a global recession, far from it. But it's also not the kind of growth that we're used to when we look at the pre-pandemic period, which was, more around 3.6, 3.8%. So we characterize this by saying, well, yes, the global economy is resilient, but it's kind of limping along. It's not sprinting right now.
Well, one of the big themes is divergence, obviously, and this is very clear from the report, that advanced economies seem to be faring much better versus pre-pandemic levels than emerging market economies and lower income countries. Specifically on advanced economies, I think it's quite interesting to note that despite the very aggressive monetary tightening that advanced economies have experienced over the last couple of years, the economic picture is still relatively buoyant. In this instance, you seem to be forecasting a soft landing for most of these advanced economies.
Right, so this theme of divergence is very important. It's important when you look at advanced economies versus emerging market developing economies, but also within advanced economies. So this sort of surprised resilience, we see it in particular when we look at the U.S., where we've revised up our growth projections for this year at 2.1%. So the U.S. economy is actually doing quite well when you consider the tightening of monetary policy. Labor markets are still very buoyant, and unemployment rates are very, very low. And we're seeing inflation coming down. It's a little bit more persistent than expected, but it's still coming down. And so that's why we are expecting that, there's always a narrow path to a soft landing. It's not an easy thing to accomplish, but it's a slightly wider path than what we were expecting before. Now, when you look across the Atlantic, you look at the European economies, there we're seeing actually a downward revision. They are expected to grow at only 0.7% for the euro area this year, 1.2% next year. There, the tightening of monetary policy, but more importantly, really the energy shock in a region that is energy dependent on Russia and elsewhere in terms of energy supplies, that has taken a toll.
I'm glad you brought up the Eurozone because that's exactly where I was going to go. In terms of growth for Germany, we're expecting negative growth at this stage, minus 0.5 for this year. But when looking at Italy, it's stagnant for this year and the next. So I was wondering, between these two economies, which one are you worried about the most?
Well, we have, in our projections, we have slightly, higher growth for Italy. I mean, we have higher growth for Italy this year, 0.7%, while Germany is expected to be in recession. So certainly Germany's situation right now is worse. For next year, actually, Germany is rebounding a little bit more. It's 0.9% versus Italy 0.7%. It's really close. It's not great, but it's rebounding a little bit. So what's going on there? Well, there are two things. First, economies that are, manufacturing-based economies like Germany have been hit by the increase in energy prices and the tightening of monetary policy. They started slowing down earlier. What we had in the first part of the year was a resurgence in the demand for services, tourism and other things. That helped support economies like Italy. So Italy was doing actually quite well in the first quarter of the year. But now services is softening. There is less demand for services as well, and that is weighing down on Italy going forward. So this is why we're seeing sort of growth prospects being revised for Italy going forward. So where does that leave us? In fact, we're going to have a soft patch. We're going to have this limping along in the European context. It's going to be there. It's going to take a while before growth sort of picks up there.
So what does that mean for the European Central Bank then, if we have an economy that's limping?
Well, it has, of course, to be paying attention to economic developments, but the primary mandate is price stability. And so we're seeing inflation coming down, and that's welcome news. But a lot of that is, especially in the Eurozone, is coming from the decline in energy price. Energy prices went up so much in the last year, gas prices, electricity prices, and that really hit all of these European economies. Now, some of them try to protect themselves by putting measures in place to protect households and businesses, but nevertheless, the impact was there. So as these energy prices have been coming down, news have been improving on the inflation front. But then when you look at non-energy, when you look at services, the price of services, we're seeing more persistence there. And so from the perspective of the European Central Bank, yes, the news is good, but more persistent inflation, it's not a time when they can start easing. So they're probably going to be staying in contractionary territory, not necessarily hiking more than where they are right now, but we don't anticipate that they would ease anytime soon.
You know, one of the big debates that's going on within Europe right now is what to do on budgets, and there's pressure certainly at an EU level for individual national countries to start reining in their spending. And the criticism is that this is countercyclical. Why should you be reducing your fiscal spend at a time when it looks like these economies, some of the larger economies, are heading towards a recession? What would your advice to policymakers be?
Well, it would be that two levels. So first, there's been a huge increase in public spending during the pandemic and also during the energy crisis. Some of the measures I mentioned to protect households and businesses against this very sharp increase in energy prices, they were very costly. On average, about 3% of GDP in terms of the fiscal costs. Obviously, these need to be unwound now. Energy prices are coming down. That is going to help improve sort of, the fiscal trajectory by itself. But there is a need also to go beyond that and to rebuild fiscal buffers. I mean, I think the worry there is that, you need to be ready because we live in a world in which there are large shocks, maybe larger than before. They can be coming at the same time, multiple shocks, the pulley crisis that some people talk about. And so countries need to be ready. And one way to be ready is to have some fiscal space. So there is really an important need for countries in Europe, but not just in Europe, that's true for the US as well, to rebuild some of the fiscal buffers. Last point is, right now, it's understandable. You might say, well, the economy is slowing down, why don't we spend a little bit more? But let's think also that doing that spending could actually prevent inflation from coming down as nicely. And so it's going to work, it's going to complicate matters for the European Central Bank. So let's make sure that fiscal policy doesn't get in the way of this first objective, which is to bring down inflation to target.